let's turn to the on-chain markets. So, Matteo, um, this is your area of expertise, although I guess that would obviously apply to Craig as well. But can you just kind of like level set for us? What does on-chain credit look like right now?
Yeah, that's a really great question, and I think that we can have, a lot of like parallels that we can draw with repo markets in general. Uh, the current state of private credit on chain is that we see real progress at the moment, but still, I would say we're still early as a market structure itself. As of today, we see that we have more than 5 billion across distributed across 2,000 different, more than 2,000 different on-chain credit assets, and that's a meaningful growth. So, but it also points to a market where there's still infrastructure building phase and not the scaling phase. What's actually working at the moment is that the borrower side has matured significantly. Institutional counterparties like FalconX are accessing credit on chain with clear terms, defined collateral arrangements, and legal structures that hold up to institutional scrutiny. That's a real change from the first generation of on-chain credit, and where the borrowers were often crypto native entities with the thin credit history and limited accountability in general. So I would say the current state, regarding the current state of credit, also the underwriting layer has also being professionalized. There's multiple professional underwriters now that do, from a credit and reporting perspective, brings traditional credit underwriting incentives or discipline to on-chain products, which is quite significant for the ecosystem in general. And apart from these, all like the better infrastructure, the better underwriting methodology, more legal clear certainty for the final borrower, and enforceability, even composability is starting to demonstrate real value. And that's exactly the parallel with repo market, because the fact that you can use an on-chain credit facility or even an RWA asset in broader terms as a collateral in a different over collateralized protocol, in a DeFi protocol, uh, well, that is something that is beyond sitting in a wallet earning yield. It's meaningful proof of concept for what the next phase for on-chain credit looks like.
Yeah.
So there's definitely like improvements from what I see looking at even like 2-3 years ago on the on-chain credit. There's still room for improvement. I would say there's still like aspects that needs to be improved from a market structure perspective, but that would be the current state of on-chain
Yeah.
credit, I would say.
I'm looking at RWA.xyz right now. I mean, like you said, the number is about 5.13 billion. It looks like by far the biggest is Syrup USDC. That's Maple Finance's lending pool for stable coins. And I mean, Craig, I see FalconX has one. Uh, I'm familiar with. Is ACRED considered here one of these, the Hamilton Lay securitized one? Does that fall under
It
this category
it
too?
should be. Yeah.
So, I mean, how is this stuff being used today? Because this type of credit, I mean, this is different, obviously, than like taking out margin on for like a derivatives type of trade and things like that. How is this being used today?
And do you mean from like our perspective as an issuer or
Both. I mean, if you could talk about specifically how people are using your credit vault, I'd love it. You don't have
yeah.
to mention names, but just even more generally, like how is on-chain like private credit being used today?
Yeah, it's interesting, and I think there's a few different buckets of use cases. And so, like you mentioned, syrup USDC, and that's why like there's kind of these different flavors, and depending on the
Mhm.
metric, we have to make sure usually that we're talking kind of apples to apples because there's a lot of flavor now of on-chain private credit. So there's some where it's essentially folks that are delegating or investing in some kind of a yield strategy. But with the idea that it's going to be, you're going to have like a receipt token or something that's going to be generating yield, or you could stake it and generate yield. So that's like, if you think about like USDE with Athena, or USDS with Spark, or Syrup USDC, it's essentially someone's going to go run a yield strategy, but there's kind of these like, it's quasi like pegged to a stable coin, and sometimes people will consider them stable coins. It's a separate debate. But it's kind of a receipt for your yield generating strategy. Then you have more like traditional private credit strategies that have come on chain. There's like JTRY, a lot of what the securitized and centrifuge folks have done. There's ACRED, Apollo's ACRED, even to some extent, Fasanara's on-chain credit facility, like kind of folks that are running these strategies in the traditional TradFi world and are actually finding a way to sort of bridge it on chain. As for them, it's a way to access obviously additional AUM, and for the on-chain community, it's a way to actually invest in private credit through some kind of an on-chain vehicle. Those tend to have stricter permissioning, but not always. There's interesting evolutions that are going on in that. But so there's kind of folks that, okay, I want to get into a traditional private credit strategy, or I want to get into a traditional treasury bond strategy, or a AAA CLO or something like that I would normally do through a brokerage. But instead I'm going to be able to now access that on chain, and that tends to be a different profile. And we, it's interesting, like with our facility and some of the others that have come out, it's a bit of a mix in a sense of kind of both concepts. Actually, is where I'd look at it. We don't have a daily liquidity concept. We don't necessarily like have a stable coin or anything like that that's going to be involved. But what you can do is you can effectively participate in the yield generated through a portion of our loan book that's been tokenized. And so it's an interesting merger, because what we like about it is you can have these facilities, and we do bilaterally with folks, or through kind of the traditional financial rails. Ledden had a big ABS just through traditional rails. But there's actually a lot of capital, a lot of interest, and a lot of unique utility that comes in when you can access the on-chain markets too. And we've experienced that, frankly, in some cases by accident, in where we've realized that, hey, folks go, well, maybe I can borrow against this token. Maybe I could do a repo type facility. Maybe someone will lend it. That's outside of FalconX, folks that may want to go do that, but it creates benefits for us too, as you sort of have this secondary market that's evolving that you didn't have as much in traditional finance. You had a secondaries market. You could, but it would be hard go and like borrow against your private credit. But the on-chain markets in some ways are a lot more agile in that sense for lending against these assets, even the traditional ones.
Okay. So I certainly see a lot of the overlap. I mean, the idea of people being able to put up assets, borrow against it. You can smart contract everything so that there's like sort of like liquidation prices and ways to roll things over. You can even create like a digital escrow account to hold things for like to release funds when certain conditions are met. A lot of overlap. But I do want to talk about a couple of things that make the repo market in traditional finance very unique, and I'm curious how you think they apply to crypto. I mean, for one, repos, I mean, they stand for repurchase agreements. They have a very specific sort of like legal, so we're looking for. Like they operate a very unique legal space. Uh, I'm not sure why Craig's smiling, but I'm excited to hear. In I guess maybe you know where I'm going, where like the owner, or I guess the lender can actually has right to those assets and can sell them directly. You don't have to go through some sort of laborious bankruptcy process, like in case there's a default, which is unlikely because these are very short term loans. But smart contracts, we all know they're called smart contracts, but they're not necessarily smart, and in the legal sense, they are not contracts. So how does that apply here? Craig, but go ahead.
Oh, yeah. I was just gonna say, I think so. This is one of the like what you were alluding to is kind of one of the. uh, So I would get asked questions all the time by people, especially like in my former role at Membrane, where we would end up talking to a bunch of different lending desks that are getting established. And if you ask anyone the question of, do I do it in a repo agreement when you're first, like when you're starting a business, or do I do it in a master lending agreement, is a big question. The answer is because like there's a few different reasons why you might want to do repo, but like bankruptcy, the avoiding a bankruptcy stay is actually like one of the core components of that, as well as sort of its classification on your balance sheet and how it's considered like from a risk perspective. But because of that, the reason I was smiling is you have to document it in a very specific way as a repurchase agreement, for it to, you know, truly be considered a repo and not just a loan. But it's been interesting in my experience, having seen repo agreements in the crypto space, and we can do either. But you find folks, you have to kind of play this translation that goes into it, and to translate a loan into a repo agreement, like we've seen term repos. Now there's an argument that, you know, you have to really watch how that's papered up to not just be considered a term loan and truly be considered a repurchase agreement. So it's been very interesting to kind of see a lot of that, more than more than I had in the past in my career, and see how different financial institutions, especially folks coming in from traditional finance who tend to like repo a little bit more, they feel that it's safer, will come and try to adapt it to the crypto markets. But then there's other reasons, taxes, et cetera, why sometimes someone may want to do something as a loan instead, or regulatory status or something like that. Um, how to answer your question though about the how do you actually go and effectuate this on chain? I mean, I'm a CFI person. I'm a HyFi person in the sense of DeFi and CFI in a sense, and so
I'm gonna steal that term. I like that.
yeah, it's actually my old CEO Carson Cook used to he coined it for me, but it's I think that um you know I think that it doesn't all necessarily have to be done in a smart contract basis. I think you could probably have a pretty robust repo market that touches the on-chain ecosystem. It doesn't have to all be programmatic. Like I think if we like what you need is a product that's going to work and scale and make sense for the people that are going to be deploying liquidity into the ecosystem. If that can all be done on chain and people can be comfortable, and then great, phenomenal. Like then people will do it. But if you have some component that has to go off chain for some reason, or everyone has to sign a piece of paperwork and then it can all be run by smart contracts or something like that, like that's fine too. And I think that is going to kind of be a nuance, like because there's like to have a lot of the larger players, like they may touch on chain, us included, but a lot of times you want some kind of a paperwork piece that's involved to some extent, and possibly to reap some of the benefits that could come with why folks do repo generally. So it was a long-winded answer, but I just like I don't think we have to like have a one-size-fits-all model as this space evolves.
Gotcha. Makes sense. And Matteo, uh, just in light of everything that how the repo market and TradFi has changed in the last few years, the natural question to ask is whether we need some sort of central bank backstop or some sort of big liquidity pool. Uh, do you see the need for that, or is there a way to handle this on chain without a quote unquote lender of last resort?
Well, that's a really good point because, you know, liquidity is one of the most visible gaps at the moment, I would say. So, you know, tokenization improves transferability, but, you know, it doesn't automatically create an active market around it. So I actually agree with Craig in the sense that there's a line between DeFi and CeFi that is kind of fading over time, and we see more and more overlaps, hybrid models between DeFi and CeFi, which it just makes sense because we don't need to force adoption of smart contract application, but it needs to make sense for the market itself. To answer your question regarding having like a central authority that backstops the liquidity, I would say that it becomes less important in a market structure built on chain that allows participants to provide secondary liquidity and tap from a global pool of liquidity. So, in a sense, these expand also the audience that can participate into these kind of markets. So it makes less important the participation of a central authority that provides backstop liquidity, but I would say it doesn't completely eliminate the need of that. So you still need to have you still like it's good to have a central authority that allows to have backstop liquidity. And I think that if we look at from an on-chain perspective with more composability and also global kind of infrastructure that can be available, it shows a coordination effort from different central authorities to make sure that they can provide all together at the same time a backstop liquidity. So I would say it becomes less significant from an on-chain perspective, but still it doesn't eliminate the need of it.
Okay. I think at this point it would make sense to just have you, I mean, maybe Craig, you could start. Just explain the setup that you guys are rolling out with your version of sort of like on-chain repo. And I have a few more questions after that, but yeah, please just sort of paint a picture for the audience.
Yeah,
And what you're doing
maybe I can set the stage and give it to Matteo to kind of go into the productization. But the I think one of the core reasons that this is really interesting, I think, at this time in the crypto ecosystem, because repo's been around forever. Like this has been a like there's always been this dynamic that there's repo and TradFi, not necessarily as much in deep in crypto. But I think what's interesting is now you have like stablecoin repo is something that I've been hearing a lot about, which is folks want to swap out their PYUSD for USDE or I need. I mean, we run into this all the time. My desk doesn't want to go in and burn something. We have something coming along the way, but we have to go settle USDT with this client right now. Wouldn't it be great if we could, access a repo market and just quickly swap our USDC for USDT and then, we'll handle it afterwards. Like, especially as all these new stablecoin products are rolling out, there's a lot of and no one wants you to go and burn stablecoins, and you may not want to. And so, like, you kind of have an interesting dynamic actually, where a robust repo market could be actually extremely valuable for those types of things, that type of activity, and it's all a lot of times kind of the short-term stuff as well as the long-term stuff. So with the abundance of these new stable coins, I think it's been that's one driving factor. And then the other driving factor is the illiquidity, like the liquidity profile of a lot of these new RWAs. And this is something that we've gotten especially involved in. And again, Matteo will go into a bit here with what we're rolling out. Is you have this gigantic problem right now where folks want daily liquidity, especially folks that are going in levered looping or as part of just their overall treasury management strategy. They need the peace of mind that this is a temporary deposit. Well, but the problem is that's not really, and ourselves are included in this, it's a huge pain to go and offer a lot of times. And it might just not work in your fund strategy of how you're deploying. You may have quarterly liquidity and maybe it's gated and you just will have a different profile on what you can offer. Well, does that mean that those folks just can't get invested in those products anymore? Maybe not. Maybe you can create different bridge facilities, repo facilities, lending facilities as ways to create this liquidity, or even deleveraging facilities, which is a separate thing we could go into for things like if the morpho markets are blowing out, you may temporarily want to delever. You could do that in a repo. And so like that, I think, is another big driving factor for why these markets make sense, because a lot of people are trying to solve this illiquidity problem with these new RWAs. And Matteo, I'll hand it to you on the product.
Yeah, absolutely agree on the, like, there are definitely a ton of different like projects and teams that are working on the secondary liquidity problem, in the sense that it's definitely tangible for an allocator perspective that with the tokenization of the credit facilities, you need to have also this kind of like instant available liquidity. I mean, in some forms, the composability again of these kind of products helps us in some ways, in the sense that I'm seeing like different flavors, different models applied to being able to provide this instant liquidity. You can have like coordination mechanism that allows to coordinate a callback with the borrower itself, which if you look at that traditional credit facility, it would have taken like days and days of structuring, legal reviews and everything. But from an on-chain perspective, instead is just a contract call, an on-chain transaction that appears. So but that's just one methodology to handle this kind of instant liquidity. You can have repo markets on Morpho, for example, where you can post the position that you had that the collateral that you posted on Morph already again. So you are rehypothecating that collateral into another market, which effectively gives you like instant liquidity that can allow deleveraging for other operational purposes, you know. And in general, like having these market participants that provide secondary liquidity and you know, even from a simple Uniswap allows to have
I'm sorry, Matteo. We're
use
having a
of these
little
kind
trouble.
uh,
I'm sorry, Matteo. I think we're having a little
can
trouble
you hear me?
hearing you. Why don't you try one more time?
Can you hear me now?
It's a little better. It's a little better now.
Yeah, sure. Okay. No, yeah, I was saying that also having like participants in the market that can provide directly secondary liquidity and you know, bear the counterparty and duration risk, which, you know, in traditional finance, there's many different firms that do this kind of role in the market. Well, what I'm seeing in DeFi and on-chain finance in general is that the combination of all these kind of projects and teams working towards this kind of goal of providing instant liquidity for RWA assets is quite significant. And I think that in the next couple of years, we're going to see quite of an improvement that would kind of make you know, quite of a no-brainer for an originator to just use an on-chain structure instead of a traditional structure. Okay.
If you've been loving Bits and Bips, don't forget that the show is transitioning to its own feeds on X, YouTube, and your favorite podcast player. If you're not already subscribed to Bits and Bips on its own channels, go there now and hit that subscribe button so you can keep up with our twice-weekly live streams and Macro Meets Crypto breakdowns. Bits and Bips will only be on the Unchained feed for a few more weeks, so subscribe today to be ready for launch. You can get all the links at unchainedcrypto.com/bitsandbips.